Corporate Finance OneNote Practice Problem. In this presentation, we're going to work a practice problem in OneNote related to expense to sales ratios, comparing expense to sales ratios. Get ready, it's time to take your chance with Corporate Finance. Here we are in OneNote. If you would like to follow along in OneNote, you're not required to do so, but if you have access to it and would like to, we are in the 317 Expense to Sales Ratio tab under the Practice Problems section. Closing this back up, we're going to have our information up top that we will be using in the problem. We'll have more references to them in a smaller version as we work through the problem. And then we're going to be calculating the cost of goods sold to sales. That's going to be the expense of cost of goods sold to sales, income statement, item to income statement, item expense to revenue. Then we're going to have the selling and admin expenses to sales, comparing another expense category grouping to sales, and then interest expense compared to sales. Then we'll take a look at a comparison of the income statement, running the income statement as a percentage of sales for the 2 years, 2000x1, 2000x2. All right, so let's go back up top. Let's see what we have. We're going to have the income statement. We're going to be doing some comparisons from the income statement, everything on a performance measurements basis. Remember, when we look at these ratios, we might have a ratio that deals with balance sheet accounts fully. We might have a ratio that deals with just income statement accounts, and then some that will deal with the balance sheet and income statement components to them. Here we just have income statement accounts that we're going to be working with, comparing expenses to what they are used to generate. So that means revenue. So the goal of the business is revenue generation. The reason we have the expenses is in order to increase revenue generation. That's why we have the expenses, so we can compare then the expenses to the objective of the revenue. Since we're working on the income statement, this is all performance type of measurements. We're having expenses that we had to expend during the time period in order to generate the revenue. So our income statement, of course, sales, cost of goods sold. So we do have inventory that we are dealing with. And this is the cost of the inventory, sales minus cost of goods sold, gross profit, selling and admin expenses being those two groups of expenses, selling and admin expenses. And then that brings us down to the operating profit. Then we're going to subtract out the expenses, or the interest expense. That'll give us the income before taxes. Taxes is going to be the 30% to give us the income after taxes. So first we have the cost of goods sold compared to sales. So we're going to say, all right, so is the cost of goods sold, if we take that from our information, we have our information down below. Once again, cost of goods sold is an expense, and it's an expense related to us consuming the inventory. When we have the cost of goods sold, it's not because we paid money at that point in time. We bought the inventory at some prior point in time, but we consumed something still, even though not cash at this time. We consumed an asset, that asset being inventory. We gave away the inventory in order to generate the revenue. So that's going to be an expense that we're going to be comparing to the sales top line item. Why did we give away the asset? Why did we give away the inventory? In order to generate revenue. In order to generate revenue. So we're going to compare the expense to the revenue line. If we divide this out, we're going to have the 73.64. Let's just do it real quick just to practice the fact that we're going to have rounding most likely, and that's going to be the 2570000 divided by the 3490000. We're going to have 0.7363, and we're always going to have to deal with the rounding. We'll move it 2 decimals over to get the 73.64 about, rounded to the second decimal there. And then we'll do the same for 2000x2. So we're comparing performance documentation. So notice here the 7364, the expenses were slightly higher as a percentage of the sales, and they're slightly less in the next year. So that's pretty close, and that's kind of what we would expect, even if there's a change in sales. In other words, there's a change in sales here. We would expect the relationship between sales and cost of goods sold to be somewhat even, given the fact that we probably have a consistent markup for the inventory. So when we sell the inventory, the difference between the sales price and the cost usually is somewhat consistent, and it'll depend on our flow, what we use for our inventory flow, first in, first out, last in, first out, average, and whatnot. But because, cost of goods sold is a variable cost, it will go up and down as we have more volume of sales. We would expect this relationship generally to be somewhat similar. If it's not, and then we'd want to dig down and say, what happened? Why is it not? And then we have the selling and admin expense to sales. So that's going to be our category, selling and admin. These are usually more fixed type expenses. There could be variable portion, but the admin expenses usually have salaried administrative people that make salary instead of hourly wages and whatnot. So it's usually kind of more of a fixed type of thing. And we might have like rent. Rent is going to be a fixed cost. In other words, as the sales go up and down in volume, many of the selling and admin expenses may stay fixed. They may not change in the relationship. So we want to keep that relationship in mind. We may talk about the behavior of costs more later, but it's useful when you're thinking about these ratios to think about, the behavior of the costs. Are the costs going to go up in relation to sales volume, or will the costs stay fixed like something like rent may do? So we're going to say selling and admin expenses are going to be picked up here on this line item. That's a grouping of the expenses that would fall under there. We're going to compare that to what they are used for the revenue generation, sales, top line of the income statement. If we divide that out, let's just do it one time for the 2000 X1, get used to the rounding. 253,000 divided by 349,000, and we get, if we move the decimal over, 7.34, about rounding up to there. So if we do the same for 2000 X2, selling and admin divided by the sales, we can see that the selling and admin compared to the sales is a higher percentage. Now, when you think about the selling and admin, like we said, we might have more of the fixed costs in there. We might have things like rent. We might have things like salaries as a large part of the selling and admin, and therefore a large part of them will not change when sales volume changes. Therefore, if you had sales like this, when it went down, sales decreased, then you would expect that the rent would stay the same. In other words, if the rent was, $10,000, it's not going to change as your sales volume go down. So even though you don't use the facility, even though you don't lose the building as much, the rent is going to be remaining the same. Therefore, as sales decrease, you would expect then the fixed cost to be basically increase, possibly be a greater proportion when compared to the sales because of the nature of the fixed cost. If sales went up and we had to pay the same rent, then you would expect the selling and admin expenses to stay somewhat constant, more constant, and when the sales go up, and then you would think it would go, this ratio then would go down just by the nature of the type of expenses that are often in the selling and admin. If we take a look at the interest expense to sales, so we're going to be picking up the interest expense. These are the financing charges. So when we take out a loan, we got to pay back the interest on the loan. We're basically paying rent on the loan. We got purchasing power, we got money, and just like if we rented a building, we've got to pay rent on the purchasing power of that money, and that's called interest. So we've got the interest is going to be for 2001 and 2, or 2000 X1 and X2 compared to the top line to sales. Why did we want that purchasing power? Because we thought it could help us to increase the revenue. So 44400 divided by 3490000, that's going to give us the, if we move the decimal over, 1.727 about. 1.27 about. And if we compare these two, it's going a little bit higher of a percent in the second year of interest to sales. Now notice the interest went up. It depends on the terms of the loan. It could be possible that the interest stays constant depending on the terms of the loan. It could be possible that the interest portion actually goes down. Many types of loans, like a car loan or something similar to a mortgage, where you pay off interest and principal, but you pay the same amount over the loan period, then you would think the interest going down year over year, because the amount applied to interest will be less even though the payment remains the same. That's how those kind of loans are set up. But that's not the only way a loan can be set up. The interest went up here, so maybe we took out more of another loan, took out some more financing, increasing the interest expense. So the sales, so you would think then if the loans were the same, that the interest expense would stay somewhat constant, and if it's a normal kind of loan, maybe even the interest expense decreasing. But here it increased a little bit, and then the sales and so in normal cases, you would think it'd be more closer to like a fixed cost than a variable cost. The interest expense, in other words, certainly isn't going to change in relation to the sales volume. Meaning, if sales volume goes up, the interest expense isn't tied to sales like cost of goods sold is. It's not going to change, increasing along with the sales volume directly. So given that nature, as more of a fixed type cost, you would think it would be doing a similar type of thing as the selling and admin, meaning that if sales go down, you would think that the interest related to the sales would basically go up, and then if it would be more of a fixed cost. And then if sales increase, you would think that the interest expense would stay somewhat constant because it's not tied to the sales. Therefore, the interest compared to the sales ratio would go down. And again, that's just basically looking at the nature of the expense. Is it something that will increase and decrease along with the increase and decrease in sales volume, as cost of goods sold is the primary example of something doing that? Or is it something that's going to stay more constant, and interest expense might be an example of something that generally would stay more constant, or at least isn't tied to directly increases and decreases in sales volume. So notice that we can now look at the income statement and compare all line items on the income statement to the sales, because remember, the sales is going to be the goal of the income statement. If you do this, if you have this type of comparison, then you can use this type of comparison to compare against other companies if you want to benchmark against other companies that make more or less than the company that we have. For example, if we wanted to compare to another company that makes much more money than us in terms of revenue, but we're in the same industry as they are, we can't compare the dollar amount too easily. But what we can compare is the ratio, and one way you can calculate that ratio is comparing every line item on the income statement, the performance statement, to what it's used for, what its purpose is, and the purpose is the revenue line, the sales line, the generation of revenue. So we're going to compare everything to revenue. Obviously, the first line would just be 100, it by itself, divided by itself. So 3490000 divided by itself, 3490000 would be 1 or 100%. Second line item, cost of goods sold, 2570000 divided by 3490000. That's going to be, if we move the decimal over, 37.64 about percent. Notice it's a very high percent, the cost of goods sold, the highest expense amount. That's what we would expect, because the highest expense for someone who sells inventory is usually the inventory, right? We had to buy the inventory, which was a substantial cost, and then mark it up in order to sell it. That's why this relationship is so important, and why we come up to the subtotal and create the subtotal of gross profit. So we could, of course, compare gross profit, which would be the gross profit margin, which is going to be the 920,000 divided by the sales, 3490000. That's going to give, if we move it over, 26.36 about. So we have there, and so that would be how much we're keeping 26.36 cents of every dollar after cost of goods sold, but before all other expenses. And that's usually a relationship that we want to keep in mind, because remember that these two will go up and down in alignment with each other, because they're variable costs, where the ones below them will not. So when we start to project out into the future, that behavior between the sales and the cost of goods sold going up and down kind of with each other, as opposed to the selling and admin usually staying more fixed as sales and cost of goods sold fluctuate, variable versus fixed costs is important. So then we're going to go to the selling and admin. Selling and admin is the 256,000 divided by the sales, 349,000. If we move the decimal over, we got 7.34% about. And then we've got the operating profit subtotal here, which would be the 664,000 divided by the 349,000. And that, if we move the decimal over, 19.03 about. And then the interest expense, you could do the same thing, of course, which would give us the 1.27, the income before taxes, tax rate at 30%, and then the income taxes. So at the end of the day, this is our net margin here, net income. and that would be the 344,720 divided by the sales. So at the end of the day, at the end of this whole thing, every sales dollar we're going home with about 12 cents, 12 to 13 cents, 12.43 cents, or for every $100, we'd be going away with $12.43. So now that we have this breakdown, note again, you can compare this breakdown. You could do this to any company, and then you can compare your line items. I lost my voice there for a second. Compare your line items on a percentage basis, which could give you more information than maybe comparing just the line items in dollar amount. So then you can do that for 2000x2 as well. So you can do the comparison. Like I say, this is our own company. So the dollar for dollar comparison is something that we can do, of course, from period to period, because we would expect that to be within the same range. We could take the difference between the $2 amount to see how we're doing. But even then, it could still get a little bit confusing because we'd be looking at all these different line items on just dollar amount, and we'd have to say, well, which of these are significant? And we might do a percentage breakout to kind of break down what would be the more significant items. This is kind of what we would call like a vertical analysis, because we're comparing on a vertical basis on the income statement to itself. And this is a within the same year analysis, meaning we're taking ratios within 1 year, as opposed to a horizontal analysis. A horizontal analysis would mean that we're going to take the difference between the 2 years, and then we can have a percentage increase or percentage decrease. So those two things can be a little bit confusing. We might look into a horizontal type of analysis later, but just note there's a difference between those two things. There's a vertical analysis. We're comparing 2000x1 to itself, everything to sales, 2000x2, everything to itself. And then we might do a difference between the percentages and look at what those differences could be, and then drill down on any major differences. And then we would also do a horizontal analysis, taking the difference, say, in dollar amount. So we'd get a different type of percentage calculation, which would be, let's take 3130000 in sales minus the prior year, 3490000. That's going to be a change. It went down by 360, but I would like the percentage change. So I'm going to divide it by the prior year, which is 3490000. If we move the decimal over, there would be a decrease of 10.31% about. That would be a horizontal analysis. We may talk about that later, but basically these calculations we've looked at here are a form of vertical analysis. Notice again, they're all on the income statement. Therefore, we haven't had to do any kind of averaging or anything like that that we might have to, or at least consider that when we have two different time periods that we're looking at, because the income statement is for a time range, and if we're comparing to the balance sheet, is as of a point in time. So if we're comparing income statement to income statement, we don't have to worry about that problem of having this timing difference issue.